I am Dr. Minal Bhandari. Welcome you all to this extensive initiative taken by our college, Pratibha College of Commerce and Computer Studies, Chinswad, under Faculty Enrichment Program, that is Spark 2020-21. At Commerce Department, we have come up with one single theme, that is commerce for non-commerce, and under that I will be sharing with you some of the aspects of direct tax, specifically income tax. Now through different slides we will focus on different aspects of direct tax. The total session, it will the total session we will cover the aspects like meaning of types of taxes, about direct tax, income tax law, lungs of income tax, sources of income, calculation of tax on total income, and two slides we will cover tax liability of a person for assessment year 2020-21 and the calculation of tax liability. Now first of all we will see about what is the meaning of tax. Now it is very natural that whenever we are using some common facility or some common kind of platform, at that time definitely we have to pay some kind of rent for that particular usage, because it is not possible actually for every citizen to develop road, to build a dam, to construct infrastructure, to construct pipeline, water pipeline, electricity, and so many basic things for every citizen. So government is taking all those projects, and we are using the facilities provided by the central government, state government, and municipal corporation. So obviously our government or the providing institution, they are some charge to be paid by every citizen. It is not possible for every citizen to pay some kind of charge for such kind of basic facilities, and that is why income tax act, they are thinking that the people who are earning more, who are earning exceeding the given limitation, they have to pay charge on that particular usage of facility, and that particular charge, that particular rent of using common or basic infrastructure designed and developed by our governments, that particular charge, it is called as a tax. So according to the definition, we can say that tax is a compulsory contribution, state revenue levied by the government on workers' income and business profits, or added to the cost of goods, services, and transactions. It may be direct tax or it may be indirect tax. Government cannot run a country without revenue, and one of the major sources of revenue is taxation. So government, they are handling so many projects which requires funds, which requires revenue, and government is not industry that they are manufacturing something and selling something, but they are taking care of each and every citizen by providing them some of the basic infrastructural facilities so that citizens can earn according to their interested area. And that is why here it is very much important to know about the concept of tax. So tax is what? It is a compulsory contribution to state revenue. And here in this first meaning, we have that it may be on income, it may be on profit, or it may be in the form of cost of goods, services, and the transaction. So in this slide, we will see about what are the types of taxes. So there are two types of taxes. First one, that is the direct tax, and second is indirect tax. Now direct tax, means tax which is levied on income of an individual, whereas indirect tax, it is levied on the goods or services of a person. That means whenever we are purchasing some kind of commodities, at that time we are paying tax to that shopkeeper, and that shopkeeper, he or she is accumulated tax to the government. That means here, that shopkeeper, that manufacturer, that seller, that wholesaler, retailer, whomsoever is playing the role of intermediaries, they are collecting the tax from the consumer and paying it to the government. And that is why it is called as a indirect tax, whereas direct tax is related with income of an individual. That means the person who is, he is liable to pay tax directly to the government. There are no intermediaries. There are only two parties. First one, that is the person who is earning something in the form of business, in the form of profession, in the form of rent from house property, in the form of selling and purchases of shares or debentures, or even lotteries and all those things. Whatever we are earning, we have to pay tax directly to the government. That is the beauty of direct tax. So, which taxes we can say that these are the direct taxes, because these are related with an individual, and obviously individuals, they are relating with income tax, wealth tax, gift tax, corporation tax, property tax, capital gain tax, securities, transaction tax, and perquisite tax. So, we are paying water tax to the corporation, and that is why it is called as a direct tax, because there are no intermediaries. That corporation and the person who is using that particular facility, and that is why these taxes are called as a direct tax. In this session we will focus on direct tax and specifically on indirect tax. Now let us see some of the important things about. So direct tax, it falls on the same person. That means the person who is earning income, that person is paying the tax, and the tax liability is imposed by the same person and paid to the government directly. Direct tax, it is progressive in nature. That means if any person is earning more income, so that particular person needs to pay more tax. So more income attracts more tax, and the burden of this direct tax is progressive. According to the amendments in budget, according to the amendments in Income Tax Act, definitely, there are changes in the tax liabilities, tax rates of income tax, and that is why the burden of direct tax is progressive. It changes according to the change in the decision of income, according to the changes in the particular budget. And important thing is that regarding direct tax, tax evasion is possible. That means the illegal non-payment or underpayment of tax is possible because of some kind of provisions. And now we will see about the another aspect of direct tax, that is how it is framed. So, income tax law, it takes care about all those income tax provisions, rules, regulations, amendments every year. And it is affecting, or we can say that it is the combination of all the provisions relating to these five different segments. First one, that is the Income Tax Act 1961. Now, this Income Tax Act 1961, it includes so many provisions regarding different concepts which comes under income tax. regarding chargeability of income tax. Second one, income tax rules 1961. They also provide guideline for income tax. Judicial pronouncements by Supreme Court and High Courts are also there. And fourth one, that is the Annual Finance Act. And fifth one, that it includes, income tax law includes notifications and circulars issued by Central Board of Direct Taxes, which is called as CDT. Every law, it plays a very important role in the smooth functioning of our nation, and that is why here in tax law takes care about smooth functioning of our nation, because taxes, they are the main source of revenue of every country. So this income tax law, it is governed by these five different aspects which we have discussed right now, and according to that, whatever the tax liabilities, whatever the calculation formats are there, we have to follow that particular provisions. Now, the main focus of income tax we can discuss with the Income Tax Act 1961. It contains different provisions for tax on income. First one, that is the determination. So, this Income Tax Act 1961, it provides standard guidelines for calculation of income tax, because this uniformity, it plays very important role in charging tax on the income of every individual. Tax Act also includes determination of tax liability, that means the provision related to determination of tax liability is there. Then third one, procedure for assessment of income, different appeals, penalties and prosecutions are there in Income Tax Act 1961, and it also focuses on the powers and duties of tax authorities. Now, before discussing how to charge tax on the income of person or assessee, first of all, we need to take into consideration the meaning of different terminologies, which we can say that these are the lungs of income tax, because this person, it is having a particular identity. So person means here not every human being, but according to Income Tax Act, person means, or person includes different kind of identities, like first one, an individual, second one, every Hindu undivided family, third one, a company, that is joint stock company, then a firm, then an association of persons, body of individuals, every local authority like municipal committee or district board, and every artificial judicial person, they are called as a person according to Income Tax Act. So person means what? All these identities on which name we can, that means government can charge income tax. Person means every identity which we discussed right now, they are called as a person because government can charge tax on the income of them. For example, said that every artificial judicial person. Now, the temple, Balaji temple, then Sai Baba temple. So on their name also, they are charging income tax, and that is why for income tax, they are treated like a person on the name of Tata Group of Companies. That Tata Group of Company is a person, or any partnership firm, it is a person. Every body of individual, any trust, it is also called as a person according to Income Tax Act. So person includes first one an individual, every individual, then a Hindu undivided family, joint stock company, any partnership firm, may be registered or unregistered, an association of person, body of individuals, a local authority, and every artificial judicial person. Second concept, that is the assessee. Every person is not assessee, because assessee is the person who is liable to pay tax. That means according to Income Tax Act, if the person is earning more than the mentioned income range, then they are called as an assessee. So assessee means a person by whom any tax or any other sum of money is payable under income tax. So that person is called as an assessee, or in short we can say that assessee means the person who is liable to pay tax. Now third one, that here we have mentioned three different terms, that is financial year, assessment year and previous year. So financial year is the year which commences on 1st April of every year and it ends on 31st March of the next year. That year is called as a financial year. So 1st April 2020 to 31st March 2021 is the financial year right now. Now here two terminologies are also mentioned which are very important for income tax calculation, that is assessment year and previous year. So assessment year, now we are knowing the financial year is 2020-21. But assessment year is the year, or it is a period of 12th month commencing on the first day of April every year and ending on 31st March of the subsequent year, which is also called as tax year or government year or fiscal year. That means the income earned in this financial year, it is taxable or it is assessed in the next financial year. That means the year in which the income earned in last financial year is going to be assessed. So that year is called as a assessment year. So in example, if we are considering the year 2020-21 is a financial year, so its assessment year is next year, that is 2021 to 2022. That means the year in which the income is assessed. That means it is evaluated, it is checked, and according to that we need to pay tax. And when we are entering in next financial year, that is assessment year, obviously the income of that particular previous year we are taking into consideration, it is called as a previous year. That means when we are going to enter in 1st April 2021 to 31st March 2022, in this whole year, last financial year, it will be treated as a previous year. In short, previous year means the financial year immediately preceding the assessment year. So, financial year and previous year, these are same when we enter in assessment year. That is very important point to take into consideration. That means when we are entering or when we are assessing the income of an assessee, at that time last financial year, it is treated or it is called as a previous year. So these are very important concepts of income tax which we need to know before learning about different aspects of income tax. Now the important income and its sources. So income can be generated through different sources. Like first one, that is income from salary, income from house property, income from capital gains, income from business and profession, income from other sources. That means through all these sources, any person can some amount of money which is called as a income of an assessee. Now we are knowing about what do we mean by assessee. Assessee is the person who is liable to pay tax, and the person, it includes different categories like an individual, any partnership firm, joint stock company, Hindu undivided family, an association of persons, body of individuals, any local authority, every artificial judicial person. So income tax, it is a tax on income, and that is why we need to identify the different sources of income. So to Income Tax Act, these are different sources of income through which income can be earned by the person and by the assessee. So, in total financial year of 12 months, whatever income is generated through different sources, these are added, and when we add income from salary plus income from house property, if we have house property which we are giving on a rental basis and we are getting rent, or if we are engaged in any kind of selling and purchases of shares and debentures and low gold and all kind of ornaments, so that is capital gains. So if we are running any business, so whatever profit we have, we are receiving, it is income from business. Or if we are professionals and we are receiving some professional fees by offering such kind of services, then it is income from profession. And the income sources which are not covered or which don't come under salary, house property, capital gain and business and profession, they are treated as income from other sources. That means the income which is incidental, like any brokerage, any kind of commission which is not fixed in nature. So such kind of income, they are treated as income from other sources. Or if any teacher is receiving remuneration for checking or correcting the answer sheets, then whatever remuneration is received, it is also falls under income from other sources. So at the end of the year, we, that means an individual or any person, they have to declare their sources of, and at the end of the year they need to declare their total income. And if they are eligible for deduction, then this gross total income is deducted by different kinds of deductions according to Income Tax Act, and after deduction we are getting net taxable income. That means the income on which the person or assessee needs to pay tax on that particular income. Now in a detailed way we will see in next session about how to calculate income from salary, how to calculate income from house property, income from capital, two different sources. So remember that there are 5 sources of income, and when we are taking into consideration all these income sources, whatever amount is there, it is called as a gross total income, and various deductions are allowed under section 80, and if we are eligible, then we are getting benefit of deduction, and remaining amount is called as a net taxable income. Now the most important for every taxpayer is assessee. That means normally, generally, we are using the word taxpayer, but according to Income Tax Act, taxpayer is an assessee. That this is the interested area of every person who is earning income. That how to calculate tax on total. First of all, we need to do addition of all five heads if they are there, or sometimes that there may be only one income source, that is income from salary, or there may be only one source, house property, or the person who is engaged in purchases of shares, the person who is selling any kind of share, any kind of debenture or any kind of property, then that income is capital gain. Or if the person is engaged in business or profession and they may not have the other sources like salary, house property, capital gain and other sources. So at that time we will say income from salary nil, income from house property nil, income from capital gain nil, income from business and profession so and so, and income from other sources nil, and then total will be called as a gross total income, and deductions, after deduction it will be called as a total taxable income. Now income tax provides the calculation of tax into three different categories. That it first one, that is the slab rate, second one that is the cess, and third one that is the surcharge. Now slab rate, that the tax rate divided into different categories based on income level. So there are chances that every year these slab rates vary from year to year. That means the exemption limit or the percentage of tax on that particular limit, they might be uh, they might be vary from year to year. Second one, that is the cess, additional tax collected for specific purpose, which is 4% on total tax. That means when we calculate total tax, at that time that assessee needs or assessee is liable to pay 4% on total tax, that is the additional tax cess. It is additional tax collected for specific purpose like educational facilities of the nation or any purpose might be there. And third one, that is the surcharge, tax on tax, additional tax charged when income earned about specific limit. Now in this year that particular limit, it is at 10% on income tax, is if the taxable income exceeds rupees 50 lakhs but not exceeding rupees 1 crore. That means if that particular range, it is in between rupees 50 lakh to 1 crore, at that time that person needs to pay 10% on tax on tax. And if that limit he exceeds rupees 1 crore, then the rate of surcharge is 15%. So this surcharge is applicable for the assessee whose tax is more than 50 lakh or exceeds rupees 50 lakh. Now, first part, that is the slab rate, which we will discuss. So, these are the slab rates or tax liability for the assessment year 2020-21. This is somehow familiar part for all non-commerce people, that is the income tax slab. So this slab, it is now divided or categorized in between three different categories. First one, that is the person below 60 years of age. Second category, which is called as senior citizens category, that is 60 to 80 years of age. And third one, that is the very senior citizens, and the range is more than 80 years of age. So first we will see about the income range for general public. So up to rupees 2.5 lakh, if we are earning income, if any person is earning income, then he need not to pay any tax. His tax liability will be nil. But if he is earning more than 2.5 lakh, 2 lakh 50,000 to 5 lakh limit, then he is liable to pay tax on 5%. Next one, that is rupees 5 lakh to 10 lakh, the range is 20, for that particular range, tax liability is 20%, and above rupees 10 lakh, it is 30%. Now, for senior citizen, that up to rupees 2.5 lakh, that particular range or limit is somehow extended, that is up to rupees 3 lakh. If any senior citizen is getting income through his retirement benefits, then he need not to pay any tax. But if he is getting more than that, then for that particular person, the range is prescribed, that is rupees 3 lakh to 5 lakh, 5%, rupees 5 lakh to 10 lakh, 20%, and above rupees 10 lakh, it is 30%. Last two slabs are common for below 60 of age and 60 to 80 years of age, that is the senior citizen assessee. But regarding first slab, up to rupees 3 lakh, he need not to pay any tax, and same thing for very senior citizens, that means the person or assessee whose year is more than 80 years of age, up to rupees 5 lakh, if that very senior citizen is earning income, then his tax liability is nil. He need not to pay tax. Rupees 5 lakh to 10 lakh, he needs tax at the rate of 20%, and above rupees 10 lakh 30%. It means for the range of rupees 5 lakh to 10 lakh, the tax rate is same, that is 20%, and above rupees 10 lakh, the tax rate is also same. But for first slab and second slab, there are some variations offered by Income Tax Department. Now, this particular tax liability we will discuss with one example. This example we will discuss with the help of Excel sheet. Here you may find Excel sheet here. Just wait. Now in this example, we are discussing about how to calculate tax liability of a person as per Income Tax Act 1961 for the assessment year 2020-21. In this example of Mr. Rajkumar, who is earning income for 2019-2020 financial year is 1 crore 2,72,000. Now we will try to calculate the tax on his income, and he is normal below 60 years of age person. Now first income slab, that is up to rupees 2,05,000, chargeability of tax is nil. Okay. In second, on rupees 2,50,000 and 1 rupees to rupees 5 lakh. That means on 2,50,000 at the rate of 5%. So on rupees 2,50,000 at the rate of 5 rupees, 2,50,000 5%, it will to 20%, it will come 1 lakh. We are discussing about the income of rupees 1 crore 2,72,000. So obviously his income range is above rupees 10 lakh 1, and that is why here directly we are taking into consideration this income range. So on rupees 2,50,000 at 5%, and on this 5 lakh at the rate of 12%, that is 1 lakh, and above rupees 10 lakh 1, that is 1 crore 2,72,000 minus 10 lakh 1, that amount will be 92. Calculate at the rate of 30%, that amount will come 27 lakh 27 lakh plus 27 lakh 81,600 100. 28 lakh 94,100. So that will be total tax of Mr. Rajkumar, whose income is rupees 1 crore 2 lakh 72,000, and that is why here we are observing the huge amount of tax which he needs to pay for the assessment year 2020-21. That means these rates are applicable for assessment year 2020-21, which might be changed in the assessment year 2021-22. So this is the total tax which we have calculated, and we have seen that surcharge is applicable if that person's total taxable income exceeds rupees 50 lakh. Now here in this example his income is exceeding rupees 50 lakh, but if it is not exceeding rupees 1 crore, then 10%. But in this example, it is exceeding rupees 1 crore. So that Mr. Rajkumar is liable to pay surcharge at the rate of 15%. That is tax on tax percent on 28 lakh 94,100 into 15%, that amount will be 4 lakh 34,150. That amount, how we calculated that it is tax on tax. So, and the range is given for surcharge, that if if the total income exceeds, it is 10%. But if the income exceeds rupees 1 crore, then at the rate of 15%. So here we will do the total So total tax 28 lakh 94,100 plus 4 lakh 34,115. It will be 33 lakh 28,250. So this is the amount of total tax which Mr. Rajkumar is liable to pay tax to the government. So this is income tax of Mr. Rajkumar, a person who comes under the category of an individual. He is liable to pay total tax rupees 33 lakh 28,215 on his income, that is rupees 1 crore 2 lakh 72,000. So this is the method of calculating tax on income of a person, income of an assessee. So in next session we will see detailed calculation of every sources of income, and after that we will see the deductions which are offered for every source of income, and after that also the end point is the overall deductions which are applicable for every assessee if the income of an assessee it is exceeding the limit given by Income Tax Act. Thank you very much.